Here we're going to look at the valuation methodology of S&P 500 index and prediction of future economic recovery based upon an analysis of stock market returns. S&P 500 index contains the 500 largest market cap companies listed on the U.S. Stock Exchange. And as of November 16, 2020, information technology, healthcare, consumer discretionary, and communication services constitutes 64% of the index. The top 6 largest market cap companies on S&P 500 includes Apple, Microsoft, Amazon, Alphabet, and Facebook. And due to the impact of the pandemic on the public equities, punishing low-growth, asset-intensive companies with higher net debt balances and low dividend yields, energy and real estate only constitute 4% of the index. And of course, the market is rewarding those companies that have low dividend yields, high price to book and price to earnings ratio, and high growth companies with low net debt balances. And as you see, this is the sector representation of the index as of November 2020. Now, in order to do a valuation of S&P index, the valuation is no different than any other type of valuation we've done before. Valuation is built upon the main pillars of cash flows, the 3 main pillars of cash flow, growth, and risk. And in this case, our cash flows are the dividends and the buybacks, which is the cash returned to equity holders. And the growth rate of these cash flows, as well as the risk in these cash flows, that's represented by the cost of equity, because this is return to equity shareholders. And the cost of equity in this case is represented by the relative risk with respect to the market, which is represented in the beta. But because the market S&P 500 is a good representation of the market, beta is 1. Therefore, the cost of equity, or the risk in this case, is simply the risk-free rate plus our equity risk premium. The equity risk premium is a forward-looking dynamic premium that's calculated at 5%, and there are analysts who calculate this return based on the level of the index, such that this value is forward-looking and dynamic. And the risk-free rate are at lows. It's 0.9%, and it's changing. It was as low as 0.4%, 0.5%, to now it's 0.9%. So in order to do the valuation, we have to come up with dividend and buyback for the period of high growth phase of the valuation, which is up until 2024, and then we have to come up with a terminal value. In order to come up with the buybacks and dividends, simply we have to come up with the dividend payout ratio and forecast it based on the level of the earnings. So the first thing we have to forecast is the level of the earnings in this case. 2019 is a historical year, so we have the dividend buyback and the earning levels, and therefore we have the dividend payout ratio. For 2020 and 2021, there are analysts that forecast these values from a bottom-up perspective and also a top-down perspective. In this case, we're using Yardeni research and Refinitiv bottom-up approach, and we have the values for fiscal year 1 and forward year 1 and 2, which is 2020 and 2021. And we can come up with the growth rate of these values year over year. We know that the terminal year growth rate is going to be capped at the growth rate of the economy, and in this case, we're going to assume that's going to be a risk-free rate. That's 0.9%. So we can basically work back these values for 2023, 2024, and 25, the growth rate, and come up with a compounded growth rate for these 5 years. And we can do the same thing for a top-down approach as well as a bottom-up approach, and we can take the average of these values to be 3.7%, and that's the growth rate that we have used for the high growth phase period. There's no need to adjust this growth rate for COVID-19 impact, because these earnings in 2020 and 21 already represent those impact of COVID-19. But for 2024, we can introduce a scalar factor to determine how much of the loss that has happened in 2020, as you see, this value is much lower in 2019, is going to be recouped by 2024. And the way we're going to do that is basically looking at if we were to grow the 2019 earning levels by that 3.7%, And if we were going to grow the 2020 levels by that 3.7% for 4 years, the difference of that value is going to be our loss, and we're going to be able to recoup either 100% of it, we're basically going back to normal phase, or we're going to have a lower percentage of earning loss recouped by the 5th year. In this case, we have put 80%. And a terminal year is basically the 2004 level earnings grown at, in this case, our term growth rate, which is 0.9%. For the dividend payout ratio, well, this is the historical year in 2019, we have the levels. And in order to come up with the values in between from 2020 to 2024, the best approach to have a continuous increase, gradual increase, is to look at the term year value. And the term year value is determined by the retention ratio. The retention ratio is determined by the term year return on equity and the term growth rate. We know the terminal growth rate based on our assumptions in the model, and we know that the return on equity is 15%. That's by looking at the historical data of since 2001 to 2020. We have 20 years of data to look at and come up with a 15.8%. And in this case, we have looked at actually all of these values for all of the indices the constituents of these S&P 500 index, and we have looked at the return on equity of each of these values. Basically, it's the sum of all of the earnings divided by the sum of all of the equity, this book value of equity, and we came up with a 15%. Later, we can look at the distribution of these values, so we don't have to come up with a point estimate for the valuation, but for now, this is our input. And once we have this dividend payout ratio, we can do a linear interpolation from 89% in 2019 to go up to 94% by the term year and get the values in between for 2020 to 2024. And as a result of it, we're going to have the dividend and the buybacks for the years in between, as you see. So the terminal value would be basically the terminal cash flow, and we have the term year as well, the terminal payout ratio, divided by the risk in the cash flow less the growth rate, which is a perpetuity formula. And in this case, the return on equity is the cost of equity is basically equity risk premium plus the risk-free rate. Our term growth rate is risk-free rate. So simply, the value of the term cash flow is divided by equity risk premium. And then we can take the present value of all of these cash flows, as you see, and add a cost of equity of 5.202% plus 0.9%, and we come up with the present value of the present value or the intrinsic value of the index of 3,227. So at this level, and given the current level of 3,600 almost, the index is slightly by about 11% overvalued. Now, when we're doing this valuation, this is a point estimate. Another way to look at this valuation is to look at a simulation of the results. So we can give a distribution to the inputs. And in this case, the inputs that we have chosen is equity risk premium as well as the return on equity. And we provided a distribution. But it's important to determine the distribution would allow us to give a distribution of the valuation. So our valuation, we're not going to have point estimates anymore, but we're going to have a distribution of the over and under valuation of the results and determine what's the likelihood that the current level of index is over or undervalued. So it's a better tool for decision-making process. It's very important to define these distributions properly. And in this case, we're using a free tool for Monte Carlo simulation. As we see, there are several different distributions, and we have to define the distribution of the input properly. The best way is to look at historical data and look at the distribution of the data. For instance, for equity risk premium, we looked at all the data since 1960s and look at the implied equity risk premium, and we can look at the mean and the median and the moments of the data. And for this, we chose a log normal distribution. For return on equity, looking at the return on equity on the index since 2020, we considered a normal distribution. So the mean and the median were almost equal, and given a standard deviation of the results, we can give it a normal distribution. And once we run the simulation, we can come up with a distribution of the values, the intrinsic valuation in this case. So the mean for the 50th percentile value is 3,208. or 3,024. They're pretty close. It's almost normal. It's log normal mostly, but it's almost normal. As you see, the intrinsic value, we have the distribution of the value. We also have the over and undervaluation. So again, the 50th percentile of the data, which is the median, is about 11%. The index is overvalued. So not by much. The markets are overvalued, but not by very much, very little. So it seems that the stock markets have picked up much faster than the economy. So the stock markets have rebounded, and it dropped significantly, especially on March 23rd when it bottomed. As we see in this case, it's dropped by minus 31% year-to-date return, and then it gradually picked up. And by now, as we look at the year-to-date return, it has almost recouped all its losses, and it's 11%. There's an 11% return year-to-date, which is better. But the economy hasn't rebounded as fast as the stock market. So one question that arises is the stock market a good predictor of the economic recovery? And if we look at we can look at the performance of the GDP, the real GDP, US real GDP. We're looking at the US market, so we look at the S&P index and the real GDP. And we can see, if we look at the returns, the quarterly returns of the data for S&P 500 as well as the real GDP year-over-year growth rate, we can see the data is so noisy and we can't really find a relationship between the data. But if we come up with the correlation of these values, it might tell us something. The economy is lagging the stock market. So it seems that the stock market is rebounded and it's picking up the pieces and building everything back up, but the economy is lagging that progression of the stock market. So the best way to look at it is to look at the correlation of the shifted data points. So instead of once we look at the returns, and once we look at the correlation of the growth rate of the GDP and the returns, if we shift the data by 1 quarter forward for the GDP growth rate, by 2 quarters forward, by 3 quarters forward, by 4 quarters forward, and so on, that means that we're looking at the correlation of the returns of the data by 1 year ahead. And we see that when we look at the correlation matrix, in 1 year, once we shift the data by 1 year or 4 quarters, we're getting the highest correlation. If we look at the S&P quarterly returns, the correlation of these returns and the GDP growth rate, you can see the correlation is 9%. If you look at the US stock quarterly returns, it's the same thing, it's 10%. But if we're shifting the data by 1 quarter, we see that correlation is increasing. If we're shifting the data by 2 quarters, and in this case, we're shifting the GDP return by 2 quarters. And the way we have done that, just to simply show this to you, is on the S&P front is basically the quarter-over-quarter return. On the GDP front, we're going to go quarter of this year over its year-over-year return because GDP is cyclical and seasonal. But when we are shifting the GDP by 1 quarter, for instance, we're looking at the year-over-year growth rate of the next quarter. And then we're dragging the data. For 2 quarters ahead, we're looking at 2 quarters ahead. For 3 quarters ahead, we look at 3, and so on. And we look at the correlation, we see that the correlation is optimized, or it's maximized basically after we do this process by 4 times. So that means that the economy is lagging the stock market. It's going to take at least 4 quarters before the economy can reach the same level of performance of the stock markets. The stock markets are a predictor of the economic recovery, and they don't have any egos. They're very humble, but it's important to read the signals that the market provides, that the stock market provides in terms of the economic recovery.